Welcome to lecture 13 of financial risk management, and we are going to start a new topic, that is the determination of forward and future price. Moving on to the contents, we are going to introduce you to the concept of forward pricing. Now remember, in previous chapters, in previous videos, we introduced you to the concept of a forward contract. Then we understood future contract, and then we had discussion on options contract. So in these contracts, we had certain values. First one was ST, which was future spot price. That was the price at the time of expiration of the contract. Then we had a K, or forward price. That was the price at which we had the contract. So in previous videos or in previous lectures, now this is the price that would be determined by the market, and this would be visible at the time of expiration of the contract. But this K had always been assumed in previous videos. But in real world, in real financial markets, this would have to be determined. And there is a mechanism to determine this K, this forward price. I mean, at which price those party would enter into that contract. So if in case the current price in the market was 100, then should they enter into a contract where the forward price is 100? Should it be 110? Should it be 90 or 80? So the idea is that how do we determine this K in real world scenario, or how it is determined? So this is what we are going to look into, and this is called forward pricing. And remember, forward price and finding the price of the forward contract or the forward price would be called forward pricing. Then we are going to introduce you to the theory behind this concept of forward pricing, which is based on arbitrage. And lastly, we are going to discuss different types of assets. We classify assets, and there are different types of classifications. But in this lecture, we are particularly going to classify asset into investment and consumption assets. And that is because for each type of assets, the process of calculating or estimating the forward price would be different. So let's get started. So how derivatives are priced? So derivative contracts are priced so that there is no arbitrage opportunity. This is the important concept. So the derivatives, or let's just say in this case we are, because not discussing about all the types of derivatives, we would have a different chapter on option pricing. In this case we are discussing forward contract or future contract. So the forward or future contracts are priced, their K value is determined in a way that do not leave the investors to earn any arbitrage opportunity, that do not leave the investors with any arbitrage opportunity. And we somehow have an idea of what arbitrage opportunity is, and if you remember, it is when the trader or investor can earn a riskless profit. So arbitrage is an opportunity where the investor would be able to earn riskless profit, and the investor who is going to take advantage or who is going to earn the riskless profit is called arbitrager. And in previous video we discussed different types of traders. We had hedgers, we had speculators, and we had arbitrager. So the arbitrager is the one that we discussed there. So the The process is called arbitrage, and the investor doing that process, the process of earning the riskless profit, is arbitrager. So to develop this theory, we have to start with an example, and let's get started with the example. Let's discuss the example. So suppose that the spot price of gold is 1,000 per ounce, and if you remember, the spot price is the price in the market today. So the spot price is, say, $1,000 per ounce, and the risk-free interest rate is 5% per annum. This is the annual risk-free interest rate. So based on this idea, what is the reasonable value for 1 year forward price of gold? So remember, we now need to calculate what we need to calculate E, but currently we aren't going to calculate, we need to calculate K, which is the forward price, but currently we aren't going to calculate K, we just are going to develop the theory. So continuing with the example, spot price is 1,000 and interest rate is 5%, but imagine that, now assume that we assume that the forward price is 1,300, right? So now in this case, we are just assuming that what if the forward price was 1,300, what would happen then? If that is the case, what would happen is that first, any investor would borrow $1,000 from a bank, right? And then he would invest that $1,000. He would borrow this $1,000 at 5%, and then the investor would buy that 1 ounce of gold at what price? At $1,000, because in spot market it is for $1,000. Then the investor would enter into a short forward contract to sell that 1 ounce of gold for 1,300. Remember, the forward price we have imagined in this case is 1,300. So what this investor is doing? This investor is taking or exploiting the arbitrage opportunity. Once the investor enters into a short forward contract, then no matter what the price is in the market at the time of expiration, so let's say if at the time of expiration the price in the market is 900, it won't matter to the investor, because he have already entered into a short forward contract, and remember, short forward contract is the contract to sell an asset. So in this case, he would sell the asset after 1 year at $1,300. So his selling price would be 1,300, right? Okay, what is his buying price? He is buying this gold at $1,000. So if I draw the timeline, this is today, this is after 1 year. He is borrowing the money today, borrowing 1,000. Why is he borrowing? Because he knows that the forward price is 1,300, so he should borrow this $1,000. He do not have the money, buy the gold, and then after 1 year he should sell the gold, right? So today he borrowed 1,000, bought the gold, and enter into a short forward contract. After 1 year, he would sell it. He would materialize this short forward contract and sell it for 1,300. So selling price would be 1,300. Buying price would be 1,000, and plus the cost of borrowing, which is 5%. 5% of 1,000 would be 50. So in this case, the buying price 1,300 and the selling price is 1,050. the profit would be 250. Now, I just said that even if the price in the market on expiration is 900, even that won't matter to this investor because he is already secured through this short forward contract. So what do we conclude from this example? We conclude that this 1300 was a higher price. It shouldn't have been 1300, right? It should have been lesser than 1300. Okay, so we have already discussed this, that this would be the cost. The trader would sell it at 1300. The profit would be 250. It would be riskless profit. We have seen why it would be a riskless profit, and then we just concluded that this 1300 is too high of a forward price. So what should be the forward price for no arbitrage opportunity to exist? And remember, we need a forward price where the arbitrage opportunity would not exist, and this is quite logical. Now you see, when there is an arbitrage opportunity, everyone would start buying in the spot market, and currently the spot price is 1000. But what would happen, because the demand in the spot market would increase for the gold, its price would increase, and let's say its price becomes 1050. What would happen in forward market? Because everyone would be shorting the forward contract, would be entering into the short position of forward contract, that would create an increase in supply of gold in forward market, and due to this increase in price, although currently the forward price is 1300, it would decrease, say, let's say we are assuming that it would decrease to 1050. So at this price, this 1050 price, there would be no arbitrage opportunity, and what we have currently developed is the theory behind the pricing of the forward contract. So we are saying that in an efficient market, this would always be the situation. The prices would always be in a way that there is no arbitrage opportunity for the arbitragers. So at what price? Now we need to develop the formula. At what price, at what forward price, that is denoted by F0, at what forward price this equilibrium would happen, or this situation would happen where where there would be no arbitrage opportunity, and that would happen when S0 is equal to cost of carry. S0 is the spot price, current price in the market. In the previous example, it was 1000. The cost of carry is any cost that the investor would have to occur to carry this contract till the expiration of, to carry this asset till the expiration of the contract. So in this case, it can be financing cost, the interest paid, so the spot price, right, and the cost of carry. We have just discussed it in the previous example. The cost of carry was 50. So if we look at this formula, what this formula is simply saying, it is saying that the forward price should be equal to the spot price and the cost of carry, and in this case the spot price was 1000 and cost of carry was 50. So that means that at forward price of 1050, there wouldn't be any arbitrage opportunity. This is what just I have calculated here. But now you would argue that what if instead of we previously assumed a forward price of 1300, in that case the arbitrager was able to take opportunity of this price because the price was higher and he would be able to enter into a short forward contract. But what would happen if future price or forward price is say 800? So in this case, even if the arbitrager buys the gold at 1000, it wouldn't be beneficial to enter into a short forward contract to sell it at 800. That would be a loss, right? So this formula starts to crumble. So if this formula isn't able to be applicable in the second scenario, then this formula won't hold, right? So let's see what would happen in the second scenario, but before that we need to develop a concept which is called short selling. Okay, so what is short selling? Now for this specific concept, you do not need to confuse it with the short forward contract or short position. For now, just assume that we aren't talking about derivatives, we aren't talking about forward contracts. It is a simple concept that have nothing to do with derivatives. So for now, just forget that there is a concept of derivatives. So let's understand what short selling is. Now before that, when someone is buying, let's say A is buying a share of a company, so what is A's expectation? That the share price would go up, right? So if today A is buying the share, so he's expecting that after 1 year its price would increase. So let's say if today its price is 100, then he would expect that its price might go to 200. So we buy a share or we buy an asset when we expect that their price would increase. And during this time of holding the share, I might also earn, the A investor would also earn a 50 rupees of dividend. So his buying price is 100, his selling price is 200, and he also earned a dividend of 250. The cash flow is 250 and the cash inflow is 250, outflow was 100, so his total profit was 150. Now if this investor anticipated that the price would decrease, say to 50, so his anticipation, his expectation are bearish. In this case his expectation were bullish, in this case his expectation are bearish. Bearish is when the market is decreasing, when the prices are decreasing, and bullish is when the prices are increasing. So his expectation are bearish. So in this case, buying this asset would give him loss. If he bought it at 100 and sold it at 50, that would generate a loss. So what if this investor also wanted to trade? So what this investor would do is, he would borrow a share today, borrow one share, let's say, from his broker, and sell it in the open market at today's spot price, today's market price. So now his selling price is what? It is 100. After 1 year, because he is expecting that the price would decrease, after 1 year what he would do is, he owes this broker one share. So what he would do is, he would buy a share from the market. Remember, he do not owe $100 or rupees to his broker, he just owe a share. So he borrowed a share, now he need to return back that share, right? So he buys back the asset at 50 rupees and gives the share back to the person or broker from whom he borrowed it. If during this time period he also earned a dividend of 10 rupees, then this dividend also need to go back to the person from whom he borrowed that share. Why? Because The broker lended him the share but did not transfer the ownership. So anything that is borrowed, the return generated from that thing would be owned by this broker. Okay, so he is selling at 100, so the cash inflow is $100 or rupees, and his cash outflow is $60. 10 was the dividend and the rest is the buying price, so the total profit would be 40 rupees. So now you can see, although the price is decreasing in the market, this specific investor is earning because he entered into a strategy which is called short selling. And what short selling is, it is selling an asset. It's just not limited to stock market, it can be with any asset. Selling an asset that is not owned by the investor. So if it isn't owned by the investor, then what do? We borrow it, sell it in the current market price, because we think today the price is higher, so we should sell it today, but we do not own the asset, we do not have the asset. So we borrow it, sell it today, and then after some time when the price decreases, we buy it back and return it to the person from whom we borrowed. This is the concept of short selling. So now going back to our second issue, which, if you remember, we said that instead of the price, instead of the forward price being 1300, we previously assumed that the forward price was 1300. If we assume that the forward price is 800, then how this investor would be able to earn profit or earn the riskless profit? So in this case, the investor can take advantage of short selling. So if I draw the timeline, today the price is 1000 in the market, the spot price is 1000 and the forward price is 800. So the investor needs to sell it today to earn profit. So what the investor would do at this time period, first he would borrow the asset, and that is basically short selling. He would borrow the asset, sell the asset in the market for 1000 and invest this $1000 in, let's say, 10% interest rate. So deposit it in bank to earn a 10% interest rate for, say, 1 year. So after 1 year, and also at this time period, he would enter into a long forward contract, and long forward contract, if you remember, was the contract to buy the asset. So long forward contract to buy asset after 1 year at 800, because forward price, we have assumed the forward price is 800. So at expiration after 1 year, what he would do is he would materialize this forward contract, buy the asset for 800 rupees, return that. So he would, and where would this $800 come from? He would get it from his deposit, which would now be equal to 1100, because of 1000 was his investment and 10% was the return. So now he would buy the asset from at the price at which he entered into a long forward contract, and give the asset back to the investor from whom he borrowed it. So the profit would be 300 in this case. So what the idea is that if the forward price in the market is higher than the price that it should be, which we call intrinsic price, then using the first strategy that we discussed, strategy 1, the investor can earn the arbitrage profit. And if the forward market is less than forward intrinsic, then even in that case, using the strategies 2 of short selling, the investor can earn profit. So the market price would be given. We can observe this market price. But the whole idea is to somehow find this intrinsic value. And if you remember your understanding of stock valuation from your business finance or financial management course, you would remember that you used some kind of model, say dividend discount model or Gordon-Growth model, to find the intrinsic value or true value of a stock. And if you remember from your understanding of the bond valuation, you use some kind of bond valuation of model to find the intrinsic value of that bond. So what essentially we want to do is we want to find the intrinsic value of a forward contract, right, the forward price. And based on that intrinsic value, we can determine whether we need to enter it into that contract or not. So the idea is to find the intrinsic value.